What if the safest place for your money is exactly where it disappears first? Most people are taught that financial safety means banks, retirement accounts, diversified portfolios, and property markets that always recover. We're told collapse is temporary, a recession, a correction, a bad cycle. But history tells a more uncomfortable story. Entire currencies have vanished. Savings have been wiped out. Bank withdrawals have been frozen overnight. Governments have defaulted. And when that happens, most of what people believe is secure fails quickly and without warning. Yet across wars, hyperinflation, banking crises, and sovereign defaults, certain forms of wealth have consistently endured, not because they were trendy, not because institutions approved of them, but because they did not depend on fragile promises. To understand what survives collapse, we first need to understand what actually collapses. For most of human history, money was tangible: gold, silver, grain, livestock, land. Value was physical and limited. That began to change with the rise of central banking and sovereign debt. And every major collapse since has followed the same pattern: excessive credit expansion. Asset bubbles fueled by cheap money, overconfidence and stability, and then a breaking point where trust evaporates. The Weimar Republic in the 1920s is a clear example. War debts led to aggressive money printing. Inflation began slowly, then accelerated beyond control. People were paid twice daily so they could rush to spend wages before prices doubled. Savings became worthless. The middle class was devastated. Yet even in that chaos, certain forms of value endured. Gold maintained purchasing power. Farmland continued producing food. Skilled workers could barter services. While currency collapsed, tangible utility did not. The same structural pattern reappeared decades later in Argentina, Zimbabwe, Venezuela, and during the global financial crisis of 2008. In 2008, people believed banks were safe, and real estate never declined nationally. But when debt tied to housing became unsustainable, the system cracked. The collapse did not happen because houses stopped existing. It happened because the financial promises layered on top of them were too large to honor. When collapse accelerates, it targets leverage and promises first. Highly complex financial products fail, then stock markets plunge. If panic spreads, banks restrict withdrawals. Eventually, currency purchasing power erodes. What disappears is not physical reality, it is confidence in claims. Across these collapses, a consistent group of assets emerges intact. Not untouched, but preserved relative to everything else. They share three defining characteristics: scarcity, independence from government promises, and intrinsic utility. These qualities form the backbone of the 6 asset categories that history shows survive economic breakdown. The first is physical precious metals, particularly gold and silver. These metals have survived every monetary regime in recorded history. Empires rise and fall, currencies are reissued, but gold remains a form of settlement that requires no counterparty. It is not a promise to pay, it is payment itself. During hyperinflation, gold does not necessarily increase in value, rather, the currency collapses around it. Its purchasing power persists because scarcity and trust in its physical properties transcend political systems. The second is productive land, especially farmland. Land that produces food holds value because it generates essential output regardless of financial conditions. During Argentina's financial collapse in 2001, many urban savers saw bank accounts frozen, but rural landowners retained access to food production and tangible wealth. Shelter and food are foundational human needs. Assets tied to those needs do not vanish when banks close. Third is access to essential commodities: energy, water rights, food supply, infrastructure. These assets are linked directly to survival. Oil does not lose relevance during recession. Grain does not become obsolete in currency crises. Even when prices fluctuate, demand persists because necessity overrides speculation. Fourth is strong foreign currency in localized collapse scenarios. When domestic currencies fail, citizens often seek stability in external ones. Now, during Venezuela's hyperinflation, US dollars circulated informally as a parallel system. While no currency is immune to long-term structural risk, relative strength matters in regional crises. People migrate toward whichever unit retains purchasing power and transactional trust. Fifth is ownership of essential businesses, enterprises providing unavoidable services such as utilities, healthcare, food distribution, and infrastructure. Speculative companies built on hype often collapse during downturns, but businesses tied to basic needs maintain demand. The difference lies between discretionary consumption and structural necessity. The sixth, and often most underestimated asset, is skill-based human capital. In collapsing systems, individuals with transferable practical abilities become highly valuable. Doctors, engineers, mechanics, builders, farmers, those who can create value without relying entirely on institutions, often adapt better. When formal systems strain, informal exchange grows, barter resurfaces, competence becomes currency. What's striking is how consistently governments respond to collapse. They attempt stimulus spending, monetary expansion, or currency devaluation to restart growth. These measures may stabilize markets temporarily, but they often increase debt burdens further. Since 2008, global debt has risen dramatically rather than declined. Instead of deleveraging, the world expanded leverage. This postpones structural reckoning, but does not eliminate it. Debt-based systems require constant growth to remain stable. Infinite expansion in a finite world eventually confronts limits. Modern parallels are visible everywhere. Record sovereign debt, expanding central bank balance sheets, recurring inflation shocks, housing affordability crises, and widening wealth concentration. Collapse today may not resemble sudden hyperinflation. It may appear as slow erosion of purchasing power over decades. Meanwhile, assets grounded in scarcity and utility maintain relative stability. 3 lessons emerge clearly from history. First, if your wealth depends entirely on institutional promises, you are exposed to institutional failure. Second, assets tied to necessity outperform assets tied to speculation during instability. Third, economic cycles are structural. Debt expands, confidence peaks, stress accumulates, and correction follows. Timing is uncertain, but pattern is consistent. Every generation believes its financial system is more advanced and resilient than the last. Technology changes, complexity increases. But complexity often conceals fragility rather than eliminating it. The Roman Empire debased its currency. Weimar printed, Argentina borrowed excessively. Modern systems digitize and expand balance sheets. The instruments differ. The dynamic remains. The question, then, is not whether financial systems will experience stress again. History suggests they will. The question is what form of value you hold when confidence wavers. A number on a screen dependent on policy decisions? Or assets rooted in scarcity, productivity, and real-world utility? Understanding this is not about fear. It is about recognizing structural patterns. Debt-driven systems can function for long periods, but they are not immune to limits. And when those limits approach, history shows that only certain forms of wealth consistently endure.